Spot or not. Nilesh Shah from Kotak AMC on the show with us. Nilesh, hi, good morning. Coming after a long break, good to have you on the show. Hope everything's good at your end.
Yes, thank you. Everything is fine.
Okay, great. Nilesh, we were just chatting about the surge in demat accounts that's happened as opposed to SIPs being slow and this whole retail frenzy which you're seeing play out on a daily basis in the markets as well. That fear of missed out or the FOMO feeling is keeping stocks abuzz as well. Do you think that's going to be really enough? And, more importantly, at a larger level, that really indicates a good sign. I mean, you can pick out reasons whether people are at home, they've got that spare change to trade into or dabble into stocks or whatever have you. But an encouraging sign, Nilesh, nonetheless.
So, participation of retail investor is always a good sign. However, our experience of the past suggests that when you are buying into Z Group shares and you believe that single-digit share is cheaper than double-digit share and double-digit share is cheaper than triple-digit share, generally that experience does not turn out to be good. Buying low-quality stocks because they are available at 20 paisa and 2 rupee and 20 rupee has never worked in equity market over longer period of time. I just pray and wish that people learn from past experiences and invest in quality stocks rather than cheaper stocks.
Right. Morning, Nilesh Bhai, Nikunj Dalmia also joining in. Nilesh Bhai, why were institutional equity flows low in the month of June? Because one would imagine that if short-term flows are a function of market mood, then in the month of May and June, if at all, everyone's made money. People should be gratified and satisfied with the market recovery given the market conditions and the economic conditions and the medical conditions. Yet when markets have come back with a force and a vengeance and which have pleasantly and delightfully surprised us, the flows in the month of June were not extraordinary.
Undoubtedly, Nikunj Bhai, in the month of June, flows dipped significantly on the pure equity side and hybrid side. Only index fund continued to receive flows because of EPFO. There are a couple of reasons why these flows have reduced. One, there is genuine financial emergency to certain set of people, and they are redeeming from their investments to put into their businesses or household. Second, there is a lot of restrictions on physical movement, especially in the month of May and first half of June. Mutual fund distributors who go and handhold customers were not able to do it as much as they were able to do it earlier. Yes, they are able to get in touch with people on digital side, but when you go and meet personally vis-a-vis when you go and meet digitally, there is lack of physical touch, lack of warmth. Now, this has also resulted into some people taking decision on their own, and they are booking profit as their returns have recovered. SIP returns, which were negative in the month of March for 3 years, have now become positive, but people are redeeming because they see that markets have moved up and our returns have become positive. Let me take profit. They are not able to reach out. Their distributors, their advisors are not able to reach out to them on a physical basis. And that is also probably resulting into a scenario where without appropriate advice, they are taking a call of profit booking.
Right. In the morning, Nilesh Bhai, we were discussing that a lot of old timers we've spoken to on the street. Me and Aisha and me were very young to remember the 99-2000 bull market, but you would remember it. Is this market behaving like 99-2000 where valuations were disregarded and markets kept on going higher and higher and higher, and that party on the upside or the trend on the upside continued for a very long period of time? So are we going through that patch of the market where irrespective of what we talk on terms of valuations or flows or fundamentals or earnings, market will disregard it?
So again, Nikunj bhai, if I look at purely from top down, if I'm not mistaken, market cap to GDP ratio in 2000 would have been upwards of 100%. In 2008, it was 149%. Currently, we are talking about market cap to GDP ratio of 71%. So there may be pockets of bull market in certain stocks, but certainly it is not there in overall market. Second, there is some similarity in what I will call low quality stocks, where in 2000 we had seen if a finance company changed its name to technology company, the stock will move up. In Z Group shares, we are seeing some of the companies running up significantly where change in management occurs or just because it is low price. So there is some similarity of a bull run in Z Group shares or low quality shares like 2000. And I just hope and pray that people learn from 2000 experience and don't make the mistake of investing in low quality stocks. Third, if we bifurcate on a bottom-up basis in Nifty, and we calculated this on 10,000 on June 30th when Nifty was about 10,300. The top 15 stocks of Nifty represents level of about 13,890, and bottom 35 stocks represents Nifty level of about 7,500. Clearly, there is a sharp polarization in some of the expensive stocks vis-a-vis some of the cheaper stocks. That was not the case in 2000 or 2008. In 2000, every Tom, Dick and Harry in telecom, media and technology was hitting all-time high level. This time, only few banks, few FMCG companies, few pharma companies is hitting all-time high level. So there is not much similarity at the top end between 2020 and 2008 and 2000. But there is a lot of similarity in low quality stocks between 2000, 2008 and 2020.
Okay, fair enough. We've also, I know you said it's not really, a reason to pick up stocks just because they're cheap, still focus on quality. But do you also see a rotation in perhaps sectoral preferences, Nilesh? Because so far the market's been pretty focused, whether it be on financials, to some extent, of course, pharma. Do you see that changing, a larger mix perhaps of, whether it be consumer names or cyclicals that may actually now start to see further interest?
So undoubtedly, some sectors will do well and some may not. However, in my opinion, theme which is working across the sector is as under. One, leaders in any sector, whether they are large, mid or small cap, are getting differentiated from the follower. So if you are top 3 or top 5 companies in a sector, you are getting one kind of valuation, one kind of investor interest. Whereas if you are a follower, then there is very, very limited interest. Leverage companies are getting shunned by investors as well as lenders across the curve, across the sector. People are preferring to invest into stronger balance sheet rather than leverage balance sheet. Between these two themes of leverage versus leadership, clearly market is differentiating across the sector companies which can raise capital, where governance track record is fine, vis-a-vis companies which won't be able to raise capital. So I will say, yes, sectors will move. Some sectors will do well, some will not do. But leverage and leadership are two criteria which is going to differentiate across the sector.
Okay. Nilesh, for those that have been feeling that they've missed out and they don't really want to completely miss a chance at being part of this rally, what would you advise? Because given some of the factors you've just described, one still has to be cautious, perhaps agile in this market. Are there still ample entry points? Would you advise waiting for a further correction? What would you suggest?
So if you are a trader, undoubtedly you need to be super agile. But if you are investor, then you need to be lazy. You should not be swayed by market movement in just short period of time. I will request investors, one, define your investment objective and create a financial plan. Consult a good financial advisor for developing that financial plan and follow that financial plan without worrying about the market. I'll give you a small example. In the month of Jan 20, most of our funds SIP returns were in double digit. A 10-year SIP return on our emerging equity fund was upwards of 17%. In March, when the markets corrected, it became 9%. And in the month of June, it has bounced back to about 12% plus. Now, this kind of variation will happen even in your SIP kind of return, SIP kind of portfolio, because that's the nature of the market. You can't be adding volatility to your portfolio by swinging with the market movement. If you have investment objectives which are well defined, you have a plan which is well defined, then just keep on executing that plan without worrying about market movements. Market's nature is to go up and down. You should not be going up and down in your sentiment looking at the market performance.
So closing comments, really. At the current juncture, if somebody wants to understand the way forward, do you think the way forward for equity investors will be volatile, or you think that the economy and the markets will continue to surprise us? I mean, if we would have spoken about where the market levels would be and what are the sound bites we will get from big companies, I don't think anybody anticipated that Nifty would be closer to 11,000 and we will see a marked recovery in auto, consumer durable and some key other sectors.
So Nikunj bhai, I think the recovery of economy is happening on a steady basis. Bharat or rural India seems to have normalized. Fertilizer sales in May were 100% higher than last May. Cement sales, two-wheeler sales is normalizing faster in May as well as in June in rural India. Tractor sales for certain companies were all-time high in rural India in the month of June. Rabi season output was higher than advanced estimate. Monsoon has been 20% above normal. Manrega allocation and direct benefit transfer to rural Indian economy will allow it to normalize much faster. So Bharat or rural India will probably will give positive GDP growth in FY21. Urban India also seems to be catching up fast. The GST collection in June at 91,000 crore was almost 3 times more than 32,000 crore in the month of April. That kind of shows that overall economy is happening at a faster basis in terms of normalization. Now, if this is the commentary going to come from corporate India, undoubtedly markets will take it positively. More importantly, on the global basis, where despite pumping trillions of dollars, they are not able to see rebound in economic activity. Compared to that, an emerging market which is able to see rebound in economic activity will also attract capital flows. The world will be full of liquidity as low interest rates. It will surge growth, and India could be in a sweet spot subject to this medical solution. So I will say I'm looking at markets on an optimistic basis, but again, I will caution retail investors, don't assume that lower price stock is the place to invest into. Learn from experience of 2000 as well as 2008. Buy quality stocks rather than cheaper stocks.
Well, that's a great point, that never in a trending market do not get blinded to risk. The minute you understand risk in a market, then trust me, the downside gets protected. Nilesh, I appreciate your time. Thank you for joining us. Stay safe and certainly hope to see much more of you going forward.